All right, great. My name is Richard C. Wilson, the Family Office Club. Today we're doing a COVID-19 panel on credit and debt investments, on public, structured, and private debt investments. Near the end of the cycle, debt investing was of great interest to a lot of investors because they wanted good quality collateral behind the returns that they had because they were losing some faith in the equity markets being so high and unsure about where real estate prices were going to go after 11 or 12-year run. So I think that there were a lot of people looking for debt investments before the crisis. Now that the crisis is here, there's interest because of distressed debt opportunities or just people wanting consistent income. But if you don't know what you're doing, then obviously you can get burned pretty quickly in this space. So the panelists we have here today, I think are a bit more experienced, have a little bit more depth than on some of our panels, in that they've been in their respective spaces for 15 in some cases 20 plus years. So I'm excited to have them here with us. Why don't we go around and do a 1 or 2 minute introduction each, just to provide background. And Clement, if you want to start, then we can go with you first.
Sure, thank you. My name is Plamen Mitrikov. I'm a portfolio manager at Cohen Company. I focus on CLOs and structured credit products. Cohen Company is an alternative asset manager with about 2.5 billion in AUM. We are particularly well known in the financial institutions lending space. Over the past 20 years, we've lent over 15 billion to regional banks and insurance companies in the US and in Europe. And we're currently still lending to small and middle market insurance companies, both in the US and in Europe. In structured credit products, particularly in CLOs, the company used to be a manager, and we have been investing in the space since 2009. Prior to joining Cohen Company, I was a senior member of the Morgan Stanley new issue desk, focusing on CLOs, responsible for origination, execution, and structuring. And prior to Morgan Stanley, I was part of the structured credit groups in Merrill Lynch and Credit Suisse.
Great. And what city are you based in, and where is Cohen Company based out of?
Cohen Company is primarily based in New York, but we have an office in Paris that is very active in lending to insurance companies in continental Europe.
Great. Dan, what about yourself? You have a 1 or 2 minute introduction?
Yeah, thanks, Richard, for continuing to fight through this and adding value to everybody. Dan Galvoni here with DPG Investments. We're a multi-strategy, private equity, family office, and alternative investment firm. And we do some merchant banking. We've done a couple billion in real estate. We've done some very large real estate deals, largest deal in downtown Nashville, Tennessee history, with $2.5 billion, the largest deal in Midtown Atlanta. And then we did a 10,000 lot deal in Austin. And then we've done a lot of credit, especially esoteric credit. So we think we're coming kind of to our heyday here. A lot of subprime auto. And then we've looked at all types of different credits. Right now, we're looking at a company that factors broker commissions for utilities. And they're the only ones doing it, and they're backed by family. So the credit space is very interesting to us. We're generally funded by about 20 families, and we have a couple institutional investors. My family's claim to fame is we were behind a company called Telzon, the global leader in handheld barcode readers. And we took 90% market share in that space and sold that company for over $1 billion in 1999. And then we bought 2 software companies out of Telzon. One was Soft Techniques, and we sold that to Mettler Toledo. And we set up a dual family office in Orange County, Newport Beach, with a real estate family. And we spun out of there. And we've been able to do, deals that we provided hundreds of millions in deals, and deals as small as 2 million checks. Thank you for the invite, as always, Richard. And we always, enjoy all the intellectual property and the great contacts you have.
Great, awesome. Marco, how's it going?
In our case, we're a 4th generation family office. Our current real estate fund focuses on hospitality. We're one of the big investors in the Melia Group, which is about 350 hotels worldwide. And we started this fund called Urban Commons out of Los Angeles about 12 years ago. Today, we own 23 hotels in the US through that fund, and we have a REIT in Singapore that basically provides the exit to all of our acquisitions in the US. As a family office, we're in alternative investments. We're also rebranding one of our motorcycle manufacturing plants in Europe, Spain, and Italy. And I reside in New York, so I basically manage everything from here.
Okay, great. Paul?
Richard, thanks for having me. And thanks always for putting together these great panels. So my name is Paul Carger. I'm the founder of a firm called Twin Focus. We're based between Boston and London in an office in Miami. We manage about $7.5 billion for a small group of families globally. And we invest across really all asset classes. So we've got, lots of experiences, with some of the topics and asset classes of other folks have mentioned here, real estate, and specifically we're pretty dialed into credit and looking at lots of interesting credit opportunities today with some of the dislocation that we've seen.
Great.
Happy to be here.
Sure. Yeah. Thanks. Thank you for being here. Playman, why don't we start out with yourself on the basic differences between public, private, and structured credit right now?
Sure. I'm sure all of us in most of our audience is hearing and very familiar with public debt, at least, and hears about it almost every day. Public debt is a very large market, and the largest component of public debt is U.S. government debt. For example, in 2019, the total new issue of public debt was about 8 trillion, and U.S. treasuries were about 3 trillion out of that number. The second largest component always has been typically MBS, mortgage-backed securities, at 2 trillion in 2019. And the third largest component, which is more relevant for this panel, is U.S. corporate public debt. This is debt issued by the largest U.S. corporations. It's mostly investment grade debt. So about out of the 1.4 trillion last year, 1.2 trillion was investment grade debt, while high yield bonds were only about 200 billion. Skipping a few components of public debt, like munis and securities issued by agencies, you have the ABS market, asset-backed securities market, which last year was about 300 billion. And the biggest component of the ABS market is CLOs, collateralized loan obligations. So in a nutshell, public debt is typically reserved for the largest US corporations and organizations. A lot of large institutional investors like pension funds, insurance companies have a mandate to allocate significant part of their portfolio to public debt for rating purposes as well as for some liquidity purposes. Private debt, on the other hand, is typically reserved for the smaller and middle market businesses, and it's done through non-traditional lending channels. In other words, not through banks, but typically through shadow banking organizations. It could be a private equity firm, it could be an asset manager, it could be a BDC, business development company, etc. The field experienced a tremendous growth after the last crisis, when the banks obviously became a little bit more handicapped in terms of how they lend. And the market has grown quite a bit. And at the moment, I believe in the US, it's about 800 billion. So again, private debt makes sense for the smaller and middle market companies. It's typically below investment grade rated. In our case at Cohen Company, for example, we experienced it firsthand, the lending to insurance companies. An insurance company may need only 20 million. If it's a small one, it's not going to approach JP Morgan to do a public offering for that debt. And finally, structured credit products, structured credit spans both private and public debt. I mean, it's essentially a tool to organize a pool of assets. It could be auto loans, it could be senior secured leverage loans, it could be liabilities to regional banks or insurance companies. By creating a structure, prioritizing the cash flows that are coming from these assets, you can achieve different rating levels and different yields for different investors depending on their interest.
Great, thank you. Thank you for explaining that. I've got a follow-up question for you, but I want to make sure and get to a couple other panelists here near the start. Dan, how do you usually structure your merchant banking deals? How does the debt component come into that? How much of your time is really spent on the debt side of things and the merchant deals that you're working on?
Well, in a real estate side, we weren't doing much. And then it turns out that we commit equity to these deals and the debt was never there. So then we started just doing both just to ensure these deals got done. On the specialty credit side, that's really all we do. So we look at these smaller businesses and we look at, we want to help them grow. Most of these businesses we invest in are heavily driven by debt. We like those models, but at the same time, we want to be able to protect our capital. So we structure these things where we get, equity type returns. So if we get into a business and a guy owns, a tax lien business or a subprime auto business, and let's say we put like 5 million to work or 10 to start, we say, hey, look, we're going to bring in a couple hundred million from clients of ours after we put our 10 million in. How much money can we put to work here? How much can this be scaled? What's the size of the market? Who are we competing with? But you can lose everything in these deals, these smaller ones. You could trip over something you would be surprised and be buying, subprime auto % discounts and have to, write money back to the bank on personal guarantees. So as much as you think you're in the money in these credit businesses, they can shift pretty quickly. We've seen, especially when you're downstream. That's where the upside is as well. So. Right.
And Clement, for the CLOs that you work in, is there a type that, maybe most people think those could be relatively risky products, but is there a type or two of CLOs that you think are pretty secure and that you go to often and provide a decent return for being relatively low risk?
So the CLOs that we focus on are broadly syndicated loan CLOs. So typically, this is a pool of assets that consists of loans issued by the top 500 to 1,000 largest U.S. companies. I mean, some very familiar names that everybody will know is like, for example, Dell or Assurion, the company that provides insurance on your iPhone if you crack the screen, American Airlines, JCPenney, household names. So these loans are typically very large. Each facility can be like, on average about $1 billion, and they are issued by large banks. So CLO essentially accumulates a pool of assets, and it's typically anywhere between 2 to 300. So they're very diversified vehicles. They're loans to the essentially largest U.S. corporations that have very strong bank relationships. So that's part of the reason why they have been so resilient in time. They've been around for 30 years. The market size right now is 650 billion. It's becoming too large for most institutional investors to ignore. But I would argue that the broadly syndicated CLO space, given the nature of the companies in it and given the structural protections that we can talk a little bit later, probably presents one of the safest parts of the structured credit markets. And it outperformed almost any other class during the last crisis.
Right. Okay. Paul, with your client base, how are your clients typically getting access to debt investments, credit investments? You're doing that through funds? Are you going direct into deals? How do you get client exposure there?
I would say by and large, we're allocating to funds, to managers in the space. There are a handful of one-off opportunities that, for one reason or another, we're participating in. Those tend to be smaller, more proprietary, and they're sized accordingly. They're typically 50 to 100 basis points positions, whereas funds, will allocate 200 to 300 basis points of portfolios. But we have a lot of GP relationships as well. So routinely, we'll get calls from GPs looking for co-investment capital.
Okay. And then since you serve so many clients, I would guess that some clients in your multifamily office might have an opinion of the market. I know some of your clients are from the financial industries. They might say, hey, I think that this may happen. Nobody knows. And they might have more of an opinion than a client who made the money in manufacturing or some other area. On top of that, you have a 40+ person team that's managing your client base, I know. So between those two things, you have a lot of collective intelligence where you stand talking to your peers as well. So in the last discussion panel that you were on, you talked about, kind of sticking to your plan, throughout a crisis, but also I would bet that some watching here are just curious as to, between your clients, your peers, and your own staff, how, defensive you're being right now, how careful, versus, more moderate in your approach. Because I know a lot of people are talking about how this is going to be a much longer recovery than people are making it out to be. And others think it's going to be I think Goldman Sachs had a report saying Q4, there was going to be a very rapid recovery coming. So I'm just kind of wondering where you guys are temperature-wise on that.
Sure. Interesting. Look, the truth is nobody knows, right? Everybody's got an opinion, but nobody really knows. And anybody that gets it right, there's a lot of luck that's involved with that because there's all kinds of exogenous factors that can come into play. And it's why, in the end of the day, I think we all have some level of diversification in our lives, whether it's diversified between credit and cash or credit and equities and gold or whatever it may be, positioning portfolio's, especially for us working with family offices, positioning portfolios for multiple scenario outcome is essential because it's our job to make sure that these families maintain their wealth, and it's not necessarily about hitting home runs. And so, we're not making massive allocation calls to be, from 30 or 40% cash down to 10% cash and allocating to equities and so on. I think everybody is in tune on this call and understands the fact that markets have come a long way in the last couple of weeks here, the last 6 weeks, since, you don't fight the Fed. Since the Fed really announced their, stimulus programs coming to market at the end of March, you've seen debt and equity markets, any of the stuff that the stimulus has touched is up significantly. And so the opportunities have waned, by and large in the public stuff. There's still a lot of opportunity in private markets. There's still a lot of dislocations and disconnect. And I think, whether it's you yourself or finding a good team that's able to help comb through those opportunities. I think initially, for example, there was huge interest when there was announcement of the second TALF program. We took a close look at that and we decided, we didn't want to make a wholesale allocation to TALF just because we felt that after the run in the markets, the opportunity wasn't as prevalent as it was, for example, back in the 2008, 2009 crisis. So, for us, with our families, we come into the year with a budget for illiquid exposure. And every year, we're presented with different opportunities. Obviously, this crisis has been certainly different than prior crisis and has offered different types of opportunities. So we've had a handful of distressed managers that we've been tracking closely for the past couple of years, looking for the opportunity to allocate. And with this most recent dislocation, these guys, many of them have opened up their funds, famous guys like Dan Loeb that have come out with a credit fund, all the way down to, smaller $5 to $10 billion managers that are, may not necessarily be household names, but have deep benches and able to kind of take advantage of these opportunities with their armies of, bankruptcy attorneys and workout crew. So.
Great. Yeah, that helps. Marco, and with your experience, I know you have deep expertise in the hospitality space, but you also have a lot of European family office connections. So I think I'd kind of like to see what you're hearing from, members of your family office in Europe and your staff, but also, other family offices that you're connected to, in Switzerland and Monaco and London, et cetera, in terms of credit or, private lending trends or interest or changes, in that area?
It varies quite a lot from each geography. So I can't really speak from the European Union perspective because Spain versus Italy to what France or what Monte Carlo is doing in comparison to the US is different, right? The support that they got from the government, the PPPT, in Europe, in countries like Italy and Spain, that's almost in existence. That never took place. They're talking about it still. No stimulus whatsoever. So a lot of the hotels that we had there suffered quite a lot. Our occupancy rate went from 90% down to below 20%. Now we're kind of recuperating. And part of that is negotiating directly with the governments. So we bypassed all sorts of opportunities in terms of, bringing more money into this, capital injections or downsizing the hotels. We let go of some of the people, but we're more like a furlough approach where we're going to get them all back. That is the promise. Once we're full capacity to work, it wasn't necessarily something that we were aiming at doing in cutback. And, it generated, like you see everywhere in the world, this anxiety of what's going to happen next. And like Paul said, nobody really knows. What we're doing differently in New York, for example, where we have one hotel, the Ritz-Carlton downtown, I made a deal with the FDNY, right? So I give them a fixed cost weekly 1/3 of the rooms that we have there. Whether they come or not, that's a different story. But at least it secures some of that part of the deals. With refinancing, which is something that we're looking at with Bank of America Merrill Lynch right now, for one of our funds, which I mentioned here earlier, the Urban Commons one. We're looking to do that this year, and they're very favorable in our position because we've done really well in the last 10 years. So we'll see. When that's done at the end of the month, I can share more information on the whole process with you, but it's something that we're definitely doing, refinancing our existing loan with them.
Sure. Okay, great, thank you. And Armando, do you want to introduce yourself for 1 or 2 minutes?
Hi, guys. Yes, sure. Sorry I'm late. There was a little bit of a confusion with time zones. I actually got those. I work with the organization. The family made it real estate in the 80s and 90s, 2000s. Around mid 2000s, John Isaac decided to launch the Isaac Capital Group, which is essentially a private equity focused strategy for the Isaac family. Our main focus are leverage buyouts, and that sort of morphed into other strategies. Most recently into the biotechnology sector, which is actually a very exciting space to be in during these times. But we typically look for investment that at least $5 million in EBITDA and up, and we partner with banks and finance the deals, typically with bank financing.
Sure. Makes sense. Great. So I had a question for Dan. So in the deals that you're doing, one thing I've been seeing is that in the private credit market, that the rates of return have gone up as obviously sources of capital have gone down. Can you talk to any changes you've been seeing over the last 6 weeks or 8 weeks in deals that you're working on in terms of expected return of investors versus before the crisis?
Yeah, so we kind of pause until there's some type of certainty. I don't see us doing many deals, so it's probably going to be another month. But if we do a deal and don't get a better return than we got going into this crisis, I don't know why anybody would want to partner with us, right? So the opportunities, they haven't floated up yet. I don't think people are seeing them yet. But in about maybe 4 to 8 weeks, we should see the bodies coming, and we're looking to be a capital provider to these companies and also take equity. So if it's a specialty finance company, we'll put up money to own a controlling rate of the GP or a minority position in the GP, and then we'll provide capital, for them to grow that business. So and we can make money both ways. You blend them, you're getting really good returns, providing large amounts of capital, then you're getting multiples on your equity at the holding company level. So we're looking to be able to deploy that strategy. We hope. We're looking at one in the real estate business in San Diego right now. They've done $700 million in deals in the last 3 years. They have $200 million on the books. They're stuck with a short-term credit facility. They got a really wealthy guy in San Diego guaranteed it. He wants a couple of young guys. They just need a new partner, a new capital structure, or they're going to have to fold their business that's been extremely profitable because the secondary market's closed up on them, and now they have a bunch of loans stuck on their short-term facility. We're giving them a proposal this week to buy controlling interest in that. So that's a great opportunity. Should have never came to us. It would have never happened unless this crisis happened. I know all the people involved, and we're expecting to see that across most industries.
Right. Yeah, no, I agree. We saw a $93 million retail property, but they were trying to, sell for the same amount they were before the crisis. Same with 2 hotels in Houston. They said, oh, well, it's got, $7 million in NOI. We said, well, does it have that now? We also saw one this morning that said, oh, well, we think the use of cars is going to be up. So our mobile app related to cars, we think is going to come back quickly because once things open up, people will be driving a lot, even with corporate offices shut down. I was like, really? So I think there's a lot of businesses that were valid before and may still be valid long-term, but if you're not getting a better return, you might as well focus on your time where you can get that excess return, obviously. Marco, what are you focused on during the crisis? It could be related to debt or your hospitality niche that, is helping your family office move forward through the crisis, given you're in, one of the spaces that's been most damaged by this, but there might also be the most opportunity with the knowledge that you have.
One will be the refinance, and we're looking at every possible opportunity there is for the first fund, and we're initiating a second fund this in the next couple of weeks, as a matter of fact. And it's going to be focused on distressed assets, very opportunistic, because there's such a displacement, and we've positioned ourselves well in the last 10 years that today we can buy more hotels. If anybody comes to me to try and buy us, any of our hotels, we're not really doing that. We have a very strong DNA. We've been around since the 50s in terms of managing and operating hotels. The Queen Mary is one of the best examples that I can give you that we own down in LA. And, we're always looking for iconic hotels positions where we can leverage also, in highly populated areas, part of the history. So we've recuperated in that one. We're at 45%, which in good days that would be crazy, but today that's optimal. In terms of debt financing, I have a very strong relationship with Bank of America, Merrill Lynch, as you know, and so we're working that out. In Europe, is UniCredit bank that we're dealing with in terms of all of our manufacturing plants, which has nothing to do with hospitality, but still, we're in real estate, we're involved.
Sure. And Clement, for you, I was just wondering if you could go into CLOs a little bit further in terms of the size of the market and how those get structured and funded and operated. I think a lot of investors aren't familiar with them. They might have heard about them in the past in some news headlines, but haven't gotten involved in investing directly in them. If you can share a little bit on that.
Sure. Again, as I said, we focus on broadly syndicated loan CLOs, where the collateral is senior secured first lien loans. So just to give you a little bit of historical data and statistics, the leveraged loan market first lien loans is about over $1 trillion. It has been around for a long time. The average default rate for the last 30 years is about 2%. Of course, there's periods where we go through spikes, like during the last crisis, the great financial crisis. The defaults rose to 9% for a short period of time. But generally speaking, because of the senior secured nature of these loans, the recoveries historically have been high, around 80%. So that's the asset class. Again, these like large, well-known names generally constitute the collateral, the fuel of the CLO. Rating agencies evaluate the pool based on risk. Generally, the rating of these pools is around single B on the collateral side on these loans. But once you structure the cash flows and introduce priority of payments, for the interest and principal, you're able to carve out at the top of the capital structure around 65% of AAA tranche that has been bought globally, mostly by banks and insurance companies, investors with low risk tolerance. And as you move down the capital structure, the lowest rated tranche usually is double B rated. And pre-crisis, it was yielding around LIBOR plus 6%. And right now, it's yielding around LIBOR plus 12%. So it's really, really far from the tides before the crisis. And when things got scary, of course, on March 23rd, double Bs were trading at something like LIBOR plus 20%. I was screaming at the top of my voice internally that this is an opportunity. I'm not saying only the double Bs, and I'm not saying jump in indiscriminately without evaluating the pools very carefully. It was clearly an opportunity that disappeared relatively quickly. The key features that make CLOs very attractive and kind of resilient through time, there's a few features. Number one, they're managed vehicles. And that's a huge distinction with some of the ABS and CMBS. Basically, you have a manager. It could be a large insurance company like Prudential, a large private equity firm like Apollo, Blackstone, KKR, that is able to take advantage of dislocations in the loan market. So, when defaults spike up in situations like this or during the great financial crisis, loans start trading at 70, 60 cents on a dollar, and the good manager is able to pick up on these opportunities and build par. Second, of course, you have the structural subordination. Every debt investor has subordination below it. Underneath the lowest rated tranche like the double B, you have 8% subordination on a 400 million pool that's, call it like 32 million. So just to give an example, you would have to have 32 million of loans default at a 0% recovery rate for the double B not to return its principal. And finally, extremely important distinction of the CLOs as opposed to the vehicles done pre-crisis is that they're matched funding. There's no price mark-to-market mechanism in the deal that can force the debt holders to liquidate the portfolio and to take losses. So in a way, it's like a bank. You secured the funding for the duration of the transaction, and that funding cannot disappear. It can only disappear if better refi opportunities appear in the market. So these features, the active management nature of the vehicles, the structural subordination, the triggers that divert cash flows, stop leakage once certain things deteriorate in the pool, they have made the asset class really outperform pretty much any other asset class during the crisis. And right now, I have to say, they still, in my opinion, presents one of the bigger opportunities in the more liquid, of course, asset class. I'm not talking about like small private debt type of opportunities that may exist, but in the structured credit markets and in general, even compared to private credit debt, it's very possible to construct a portfolio with mid-teen returns. And there's a lot of uncertainty, as Paul said, and I agree with everything, right? It's still not clear what's going to happen to the markets, how companies will restore their earnings, but it's a great opportunity. It's usually in times like that that great returns can be achieved.
Sure. And Clement, from your perspective, your team, managing over $2 billion in debt, you're analyzing companies, looking at their balance sheets, looking at, taking positions, in the credit market. So you have a unique perspective from most investment professionals looking at the health of companies on a broad basis. So what type of recovery, is your team talking about as a most likely scenario? Obviously needing to plan for different things unfolding because we can't predict what the government's going to do or what the virus is going to do. But what's kind of your team's kind of thesis on what's the most likely scenario that you're structuring around?
Yeah, we, during the last crisis, the default spiked up to 8%. So when we're running our stress scenarios in CLOs, we're using that for actually more than 1 year. We're, extending it for 3 years. We're certainly not expecting that necessarily, but we stress things really hard. And on the recovery rate, even though these are first lien senior secured loans, we're running recovery rates of 50%, which is much, 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 much below the historical levels. And there is some reason to stress the recoveries because obviously, and most people may know, the majority of the loans have become covenant light. So when a loan is covenant light, there's some leakage that can happen before a default, and the ultimate recovery can be lower. So we think it's appropriate to be very defensive and careful when analyzing the portfolios. You certainly have to look at the manager behavior as well. CLOs are very diversified in terms of sectors as well. They don't focus like the historical CDOs, which is a bad name, but it's a very different animal. CDOs were extremely highly correlated. Everything was, focused on mortgage-backed securities, while here we have all the sectors represented and typically about 10% of the pool. Right now, obviously some sectors like hospitality, gaming, aircraft are being hit very hard. Energy as well, of course. So you have to be very careful how you analyze it. But we think that even with the most stressful scenarios that we don't really expect, we still expect the triple B tranches to return everything and even most of the double Bs.
Right. Okay. And Dan, I know you're pretty well connected in the family office space, California and across the country. What's the type of recovery that you're structuring around in terms of you and your peers? Are you seeing this as a longer, it's going to be 9 months, 2 year type recovery, or a quick kind of Q4 things getting mostly back to how they were based on the investment actions you're taking?
So I represent, we have the wealthiest real estate family in the world. as a client, Orange County. So they're close to 60 billion. We have some very large liquid families. So what we think is going to happen is that we're going to be in a tough restructuring for 9 to 18 months. And then we think America is going to go into an euphoric cycle. We think all the foreign capital, anybody that's, was putting money in Asia, the Middle East, South America, it's all going to come back here. Everybody wants to come here. And then we think, since Americans, consumer is 70% of the global GDP, when they see made in China, we see them not wanting to buy that much longer. So we see a lot of high paying manufacturing jobs coming back to America, which, private equity and other family offices, they're not going to take that risk, we think, to have their supply and demand chain over there. So that's going to bring, our economies in the service-based economy, but now it'll go back to, high-paying, high-tech manufacturing.
Okay.
So we think when Trump stays in the White House, we're going to go into an unbelievable growth period after about a year or two.
Right. Anyone else here changing their investments or helping clients guide through a potential fallout of U.S.-China relations, or businesses relocating from China to the U.S. or other Asian countries? Anyone seeing that or discussing that with your teams, as Dan mentioned?
We're seeing it. I agree with Dan. We're actually super bullish on America coming out of this crisis, and obviously tech and biotech have been winners here, and we think they'll continue to be winners. I will tell you, I think near term, I think the markets have come a long way, and maybe a little too fast. Things are not cheap. But again, I think it's all predicated on seeing, whether it's a second wave or, really what happens over time is nobody's going to flip a switch and tell us that the pandemic is over. It's going to be gradual. It's going to just, it's going to take time for people to have confidence in terms of getting back on planes or, go to sporting events. But eventually there will be a shift in sentiment. And it's not that this virus is going to be completely eradicated. as we saw the news overnight with Moderna here in Boston having a vaccine, they've even said with $500 million, they're still only going to be able to produce 50 to 100 million vaccines. So it's really going to be a change in sentiment as opposed to actual fundamental changes. Slowly, you'll continue to see the disease wane. In our opinion. And, I agree with Dan. I think if we don't have the second wave, I think it's going to be really off to the races.
Right. Okay, great. Marco, do you want to comment on that and any international comments or just the cycle?
Sure. So from the manufacturing point of view, because we're manufacturing in Italy and northern Spain, we've made it very clear as a mandate that we do not want to be buying any parts that are manufactured in China right now. That's the sentiment. I want everything to be made in Europe, and the made in Italy, of course, has a much stronger value than it is. We're manufacturing electric vehicles, which is right now basically also a bit bureaucratic in the U.S. Take for instance what Tesla is doing, right? In the U.S., to be able to sell in every state, you've got to have a dealership license in each one of them. Tesla isn't doing that, and he's been fighting them for a long time. So I'm kind of now into that club of fighting against the dealerships and concessionaries, because we're selling directly to the client, right? Manufacturer to the client needs. In terms of the currencies that we like to accept, I'm still very bullish on the US dollar, the euro, and the British pound. I'm not going to be accepting yuans at all. So that kind of answers a lot how our sentiment is right now from a European and an American perspective.
Right. Okay, great. And that's helpful. Armando, do you want to talk a little bit more about either credit or debt investments that your firm is doing, or related to just kind of the sentiment on the cycle recovery?
Sure. Well, right now we're not investing in credit. We're sort of supplying the demand for credit, because typically we borrow money to make our investments. So to the point regarding CLOs and how safe they are, it really becomes questionable in regards to a stress test scenario. Because, for example, for a lot of companies where we have to acquire them with outside financing that's behind the bank, we still call it a bifurcated deal. So essentially the bank has a first lien on all the assets, hard assets of the company, and a non-bank would have a lien on all of the intellectual property of the company. So these assets are essentially assets that in a stress test scenario, they're non-existent. So yes, they're first lien, they're first out. But when you look at what these CLOs are made up of, that first lien is worth something in an economy where everything is going well. If you're in a scenario where the company starts liquidating, the bank will always have the first out in all of the assets, and they'll get to collect 100 cents on the dollar. And if there's anything left, then the loan that got converted into a security into the CLO, that gets paid out last. So we never really went into investing in the CLO market or securities because we essentially know what these securities are made up of. All of our competitors in the private equity space and in the family office space, we're all utilizing this mechanism of financing in the good times, but it's really hard to supply the demand for this debt, that AAA rated debt during these times. So we were not really an investor into debt. We were issuing debt that was being bought by these funds and in turn tranched and sliced and being sold to pension funds and insurance companies. I believe that we are not going to have a vaccine by the end of the year. To the Moderna comment, yes, they have successful phase 1 trials, but all that means is that the vaccine is safe. The phase 2 trials will really figure out if the vaccine is efficient in blocking the virus, right? So yes, this is all great news, but when you really get to understand what a phase 1 trial does and a successful phase 1 trial means, it just means that nobody died taking this vaccine. So now it's moving on to the efficacy phase of the studies. So during this period, we have been in the process of acquiring a company that makes parts for manufacturing companies. And they're one of 3 companies in the United States that are left. We're in deep discussions and we're getting to make this investment. And the whole thesis in what we're seeing in the marketing, who we're talking to down the supply chains, problem that a lot of manufacturing companies in the United States and even retailers are having is the supply chain problem where they can't get anything in from China. So everybody's scrambling to find parts all around the world that are not in Asia to get these parts into the United States to be able to put together whatever it may be, cars, washing machines, airplanes, because the supply chains were so globalized, everybody's rethinking how their supply chains are working. And that's especially true within the auto manufacturing industry. So I do agree that everybody is going to look at manufacturing here in the United States, and we're cautious, but we're optimistic as well.
Right. Yeah, no, I appreciate all those comments, and I know that I see on LinkedIn, on Facebook, and social media streams, people talking about bringing manufacturing, back home more aggressively and domestically in different countries, and I see some other people reacting to that, talking about racism and bringing up anti-Asian sentiment, but I really see it as against China, not anyone of Asian descent or from different Asian countries that are more friendly with the United States, such as India, etc. So I think it's really timely to hear those comments. But Clement, I know you've got deep expertise in the CLO space. Do you want to respond a little bit to how you navigate the space in relation to what Armando talked about? So I know there's possibilities to custom create tranches, etc.
Just very respectfully, I mean, the CLOs are comprised of bank loans, right? I mean, these are the bank loans that go into the CLOs. At least I'm talking about the broadly syndicated CLOs. They are the first priority. So I wasn't quite following a little bit like what can be in front of them. So that's why historically the recovery rate, of these loans, even during crisis, has been, very high. At the moment, we do think that it can be lower, maybe like in many cases around 50%, but we certainly, don't expect much lower recovery than that. Now, lower middle market and middle market CLOs are a different story, and I can't quite comment on that. But with the largest U.S. corporations, as I said, like Dell, Shurion, etc., we feel pretty comfortable with the asset class and with the recovery on these loans if they go into default.
Richard, I agree with your comment. It's the lower middle market and the middle market CLOs that I would be very concerned with.
Very concerned. I totally agree with that. I mean, it's just not the right moment, especially in the current environment. We definitely need to see how things will happen. And yeah, certainly there'll be some serious issues there. We expect that. Even in the broadly syndicated space, you have to be careful because there's usually some buckets, and we're very careful to see how, what percentage of the portfolio in the broadly syndicated deals is actually middle market. So you have to be very careful to navigate that. But generally speaking, again, with the quality of the borrowers in these like large broadly syndicated deals, we feel very comfortable, and we think the opportunity is unbelievable. The last opportunity was in 2016, early 2016 and 15, but that was more of a liquidity crunch based on the energy and commodity prices. And this time, as opposed to the great financial crisis, I mean, we had like a tremendously fast widening. I mean, it happened really fast. During the crisis of 2008 and 9, it took about 18 months to find the bottom. Every time we thought we had a bottom, the floor opened, and you kept going lower and lower. While here, in about 3 weeks, you reached levels that were unprecedented. And a lot of people realized it's a great opportunity, but you still have to be careful how you tread in that asset class. I agree with Armando.
Sure. Dan, do you want to explain what type of a deal would, get you out of your chair and kind of stick out from the other things that you're seeing right now? When you said you're expecting to see deals in 4 to 8 weeks coming up, they're going to be kind of right down the fairway of what you guys look for. What would you be looking for right now?
Investors who are tired, who maybe have problems. They're in a decent business, but they have problems in their other businesses. So they need to get out. They need cash. So maybe we could buy equity positions for 50 cents on the dollar. Companies that are good companies, like I explained earlier, this commercial real estate lender that we can take over and add other products and expand. So if they have a decent footprint with good track record, stuff like that, then we could take it over and then take them into, like, for example, we're launching a GP fund. There's no GP lower middle market real estate funds providing fund capital to sponsors. Sponsors don't have the co-invest, they don't have the chase money, but they have good deal flow. So we're going to see distressed debt, and they're going to find these distressed debt deals where they can buy maybe an apartment deal or a retail deal that's $20 million loan for 10, but they need $1 million they have to put in, and to partner with institutional capital so we can provide that for them. So we're looking to be a part of that, but we think special situations. I mean, special situations, divorces are going to be big time, and people are going to have to sell assets. Banks are going to pull out, or private lenders are going to have problems in other parts of their businesses, and they're going to stop funding good companies or good projects, and maybe we can come in and take pieces of that. We're not sure, but kind of like a tiger that hasn't eaten in a while, you have to be alert, and when that mouse moves, you kind of have to pounce. So we just want to stay alert, and then we think that the opportunities will come.
Right. Yeah, it's interesting you mentioned that. I was walking through a real estate asset yesterday where the owners were very motivated because of divorce, and they wanted to sell it very quickly. We walked through another asset down the street. They said they were motivated, but they wanted the same price as pre-crisis. So I said, well, I guess they're not too motivated. I mean, when there are things that have been repriced, people are going to choose to invest in those if they're just as healthy as a thing, which people are trying to pretend like there's not a crisis, on our hands, obviously. If any of the attendees would like to submit questions, please feel free to do so at this point. I know with 6 people here on the panel, it really means we're each talking for only 8 to 10 minutes. There's not a lot of time for each of us to get across our viewpoints and kind of explain an important insight or something that your team has been talking about. Each of you has a different network of family offices and investors and deals that you're negotiating, term sheets you're looking at. So I wanted to go around and give each of you one more chance to comment on either an insight you wanted to get across during the panel, maybe something counterintuitive, or the most interesting way that you're approaching, the virus in terms of opportunity set or structures that you're looking to deploy, et cetera. For myself and the Family Office Club and our clients, we've had multiple clients invest in the life settlement space because it's just uncorrelated to other things. They're taking time to do due diligence on that now because they're not sure where other things are going. But the longevity of human beings, if anything, it's getting worse, and the returns get affected by longevity. So we've seen interest in that, and also in gross revenue royalty. Structured operating business deals are the two things we've seen the most interest in recently. Armando, is there anything else you'd like to add related to your mandate or your team's insights before we end the panel?
Well, at this point, we're really taking in the data as it comes in. Initially, we all thought that this would be a quote unquote V-shaped recovery where we would be closed down for 15 days and we would be open by Easter and everything would go back to normal. And that's certainly not the case. So as new data comes in, we sort of see a cascade of layoffs and unemployment, which is starting to become concerning, right? Initially, we looked at retail, and the massive layoffs were really just in retail, but that has now sort of cascaded into other sectors. So we're really just monitoring the situation. We remain bullish because of the $3 trillion plus that have been printed to get the stimulus out and stimulate the economy. So we'll certainly see that happening again. Our concern are really the metropolitan areas when they'll open again, and in cities. So we remain focused on just taking it in as it goes, because as new data comes in, you figure out different things and you have different viewpoints on the situation. Obviously, we're in an election year, so depending on that as well, we really don't know what's going to happen. It could go one way or the other. So we're sort of getting prepared to what happens if it doesn't go the way we want it to go.
Right, for sure. I hear people oversimplifying things, of course, but saying, well, Trump is the business guy to have there to help us recover. And other people say, look how bad he messed up. For sure, a Democrat's going to get elected. So I think that, obviously no one can predict the future on that either, but that's a good point. Another unknown coming our way. Paul, do you have any last comments? I think you have to jump right on the hour. So I just wanted to give you a chance.
Yeah, I mean, I think, for your audience and folks that may be less experienced than the panel here of looking at opportunities, I think it's just really important to look at a lot of opportunities. I mean, it's, pretty easy to fall in love with one in a vacuum, but until you really know what else is out there, you just need to look at a lot of stuff. In Boston, I always say to my team when we've got some interesting opportunity on the table, why us? Why are we so lucky that it actually showed up why did that Texas oil deal pass all the other Texas oil men to find its way to the Back Bay or Mayfair in London, to us. So, always ask yourself, why is it on my desk? And, but for sure, there's going to be lots of interesting opportunities because even if, we did flip a switch and everybody's back to work and traveling tomorrow, there's been some lasting impacts. There likely will be over the near intermediate term, a change in consumer sentiment. Long term, we're human and we all have short memories, but short term and intermediate term, there's definitely going to be some big impacts. So,
yeah, it's a great point. As an investor, you got to see a lot of deals to get a top 1% be excellent. But the flip side of that also is if you're raising capital and you've gone to 292 investors and no one's even leaned forward and take a meeting or take a phone call, in my experience, the excellent deals get funded a lot quicker, obviously, than the mediocre ones. And so if you're not getting anybody leaning forward or any momentum, it could be the structure of the deal, could be the team, could be the timing. But I think that's a form of feedback, in nature as well, right?
And bad deals, you don't only lose money, but, they take years off your life, as I'm sure this entire panel can testify to. So.
Right. Yeah, for sure. Thank you, Paul. Dan, any last comments you'd like to leave us with today?
Yeah, so we want to stay positioned as a user-friendly, nimble capital provider. And saying that, we're looking at the commercial real estate space closely. We know how these loans are structured, so we know when occupancy drops in hotels below XYZ or multifamily or whatever, then they're in default, and that's happening. And all it takes is watching to see what lenders are going to do. They're going to take it back. They foreclose one, then you do an appraisal. Now the whole within 5 miles, every asset needs no equity, and all of them are underwater. So that hasn't happened yet. So the new normal is going to hit reality in about 90 days, and then people are going to get real. And we're greatly looking forward to that.
Right. Yeah, for sure. We were doing trying to get an appraisal on a piece of real estate, but of course all the comps were pre-crisis, so they're pretty much worthless. You know, the comps meant nothing. They were trying to justify the price based on comps.
One foreclosure, one bank REO, and watch how it all just starts just pushing down all the values. The bubble, they're already, commercial real estate values are too high already. So we already had a bubble before the corona.
Right. I mean, luckily, 80% of the sophisticated investors out there shored up their cash. They knew winter was coming. They should have known winter was coming. It just came in a different form, you know, I guess. So that's the only good news in all of this. It didn't come like 2 years into a bull cycle or something like that, right? Yeah. Marco, any last words? Let me unmute you here. Oh, there you go.
You kept me quiet. Listen, there's a number of ways of looking at it. We're as investors, we're always looking at how any fund reacted during the crisis time, not so much when the times were great, because everybody made money. So I look at that, and this is what I'm looking at right now. Who is making money during this crisis right now? Because that makes the difference in terms of who is out there doing what. Everybody's been hit, but there's some people that are making some serious capital. So you want to take a look at that. You mentioned something about racism, you know, with there's not an anti-Chinese sentiment because I would sell to them. I just don't want to buy anything there until I feel confident enough that they have a good handle on what they're doing and how they're dealing with the world in terms of, you know, communications, how the government is seeing these things. That's it. You know, and then hopefully that change. In terms of the crises and consumers always adapt no matter what. This is just going to be another period where consumption has to be adapted to it. And if you are providing services, you have to adapt to the way people want to consume. So I think the best line here is safety. Everybody wants to feel safe, whether they go to a hotel or a gathering event, whatever the case may be. So you have to provide that now and almost guarantee it. So we're looking at mandates within our companies to provide that safety note to all of our clients.
Right. Great. Yeah, good points. Clement?
I would mirror a lot of the sentiment expressed by my fellow panelists. Safety is the number one priority for us right now. There's a lot of uncertainty what's going to happen on consumer behavior in general, but safety is the most important, that you don't lose your money and that you make money in this opportunity. And we're also very excited. I mean, the dislocation, as I said, in the structured credit products, in particular CLOs, has been very, very severe. And we think we can easily achieve distressed type of returns with almost investment grade risk. It's not, of course, the time to be crazy. We're not going to know what's going to happen for sure with all the earnings and all the companies for quite some time. But the opportunity that's presented right now, we think, is extremely attractive, and we're very excited to focus on the space.
Sure. And Clement, I know you're watching earnings closely with a lot of these large companies, and Q1 was kind of a half good quarter, half disaster quarter for a lot of companies. Q2, a lot of people are saying is just going to be pure disaster quarter. And obviously we're seeing that. What was that?
And maybe Q3.
And maybe Q3, right? So are you guys looking at when earnings are going to be coming out in July and kind of thinking that that is going to be, you know, one of the toughest times of this year when that full bad Q2 comes out with all the earnings reports? So that's going to be a significant point in time this year in the economy? Or do you think it's going to be more just continual bad news kind of rolling out more steadily?
We think that it's probably not just Q2, but Q3 as well. So we're not kind of counting for one immediate pain and so on. It's more like what my fellow panelists said. It's going to continue probably for quite some time, for like at least 6 months. We're not, you know, But the nature of these big companies, and we've analyzed the portfolios, they can all of them get through the liquidity crisis right now that not generating, and eventually it's gonna start demonstrating itself in 2021 when earnings are not quite at the same level. Can they service the debt? But even in our stress scenarios, as I said, we feel very comfortable, and now is the time to differentiate yourself from your peers by generating good returns, and we think there's great opportunities.
Right. Great. Okay. Great. Well, thank you for joining us. Everyone listening to the panel, thank you, panelists. I know a few of them had to jump for their calls that started 1 or 2 minutes ago with other clients, but I appreciate everyone's input here. And we recorded this in case you missed the first part of it. It'll be in the membership portal. We're having another discussion panel Thursday this week, and then a live webinar next week, I believe on Tuesday. So hope to see you on one of those again live soon. Take care, everyone.
Thank you.
Bye.